Theme 4, Making Markets Work, builds on earlier economic understanding by examining how different degrees of competition affect market outcomes and how governments can intervene to improve the functioning of markets and the wider economy. This theme develops ideas first introduced in Theme 1 by exploring competition, market power, regulation, and market failure in greater depth, while also introducing macroeconomic policy and the role of financial markets. Firms operate in markets with varying degrees of competition, and this affects their decisions and the way in which resources are used. The spectrum of competition is a way of showing how markets range from having many competing firms to being dominated by a single firm. The different types of competition are monopoly, oligopoly, imperfect competition, and perfect competition, each defined by the number of firms and the level of competition. A monopoly is a market structure where one firm is the sole producer of a good or service with no close substitutes. The characteristics of a monopoly are a single dominant firm, high barriers to entry, price-making power, and limited consumer choice. An oligopoly is a market structure where a small number of large firms dominate the market. The characteristics of an oligopoly are few firms, high barriers to entry, interdependence between firms, and the use of both price and non-price competition. Imperfect competition is a market structure where firms have some control over price but still face competition from other firms. The characteristics of imperfect competition are many firms, differentiated products, some barriers to entry, and a degree of price-making power. Perfect competition is a market structure where many firms sell identical products and no single firm can influence the market price. The characteristics of perfect competition are many buyers and sellers, identical products, perfect information, free entry and exit, and price-taking firms. The model of perfect competition helps explain how markets work as it shows how supply and demand interact to determine price and output efficiently. The limitations of the model of perfect competition are that it is unrealistic as it assumes perfect information, identical products, and no barriers to entry. The impact of market structure on pricing strategies is that firms in more competitive markets have less control over prices than firms in less competitive markets. The impact of market structure on customers is that higher competition generally leads to lower prices, better quality, and more choice. Non-price competition is competition between firms based on factors other than price, such as branding, quality, advertising, and customer service. A barrier to entry is any obstacle that makes it difficult or costly for new firms to enter a market. Contestability of a market is the extent to which firms can freely enter and leave a market without significant costs. Ease of entry is the degree to which new firms are able to start competing in a market quickly and cheaply. The different barriers to entry are product differentiation, branding, startup costs, intellectual property rights, and research and development and technology change. Product differentiation restricts entry into a market by making existing products appear unique, reducing the appeal of new competitors. Branding restricts entry into a market by creating strong customer loyalty that new firms find difficult to overcome. Startup costs restrict entry into a market by requiring large amounts of initial capital that many potential entrants cannot afford. Intellectual property rights restrict entry into a market by legally preventing other firms from using protected ideas, designs, or processes. Research and development and technology change restrict entry into a market by requiring advanced knowledge and high investment to compete effectively. The impact of barriers to entry on market structure is that they reduce competition and allow dominant firms to maintain market power. Economies of scale are cost advantages gained by firms as output increases and average costs fall. The impact of economies of scale on cost and price is that larger firms can produce at lower costs and charge lower prices than smaller rivals. Economies of scale affect barriers to entry as large firms' lower costs make it difficult for new entrants to compete effectively. An oligopoly is a market structure where a small number of large firms dominate the market. Competition in an oligopoly is characterized by interdependence between firms and price stability due to firms avoiding price wars. Concentration ratios are measures that show the percentage of total market share held by the largest firms in a market. Concentration ratios are calculated by adding together the market shares of the largest firms in a market. The concentration ratio of a monopoly is 100% as a single firm controls the entire market. The concentration ratio of an oligopoly is high, usually above 40%, as a few firms hold most of the market share. The concentration ratio of imperfect competition is moderate as market share is spread across many firms with some dominance. The concentration ratio of perfect competition is low as no single firm has a significant share of the market. A tacit agreement is an informal understanding between firms to avoid competitive behavior without any formal arrangement. These are found in oligopoly markets as firms recognize their mutual dependence and prefer stable prices and profits. Price discrimination is the practice of charging different prices to different consumers for the same product. This is found in oligopoly markets as firms have market power and can segment consumers based on willingness to pay. Business objectives are affected by costs, revenues, market conditions, competition, and the aims of the owners. Pricing decisions are affected by costs of production, level of demand, competition, and the objectives of the business. The impact of objectives on pricing strategies is that businesses choose prices that best support aims such as profit maximization, growth, or market share. Average cost is calculated by dividing total costs by the level of output. Average revenue is calculated by dividing total revenue by the number of units sold. Profit is calculated by subtracting total costs from total revenue. These affect business objectives as firms must cover costs, achieve desired profit levels, and remain competitive. These affect pricing decisions as prices must be set at a level that covers costs while meeting demand and profit targets. Marginal costs are the additional costs of producing one extra unit of output. Marginal costs are calculated by finding the change in total cost when output increases by 1 unit. Marginal revenue is the additional revenue gained from selling one extra unit of output. Marginal revenue is calculated by finding the change in total revenue from selling one additional unit. Marginal costs and revenue affect business objectives as firms aim to maximize profit where marginal revenue equals marginal cost. They affect pricing decisions as firms consider whether producing and selling extra units will increase overall profit. Contribution is the amount each unit sold adds towards covering fixed costs and profit. Contribution is calculated by subtracting variable costs per unit from the selling price. The link between marginal costs, marginal revenue, and contribution is that all help firms assess the profitability of producing additional units. Productive efficiency is achieved when goods and services are produced at the lowest possible cost. Allocative efficiency is achieved when resources are allocated to produce the goods and services most wanted by consumers. The difference between productive efficiency and allocative efficiency is that productive efficiency focuses on minimizing costs, while allocative efficiency focuses on meeting consumer preferences. The significance of the margin is that decisions are made by weighing opportunity costs and trade-offs, helping achieve allocative efficiency. Improving technology can increase productivity by enabling firms to produce more output with the same amount of resources. Improving human capital using training and education can increase productivity by increasing workers' skills, efficiency, and adaptability. Improving the quality of management can increase productivity by improving organization, decision-making, and the efficient use of resources. The structure of production in an economy refers to how resources are organized across different industries and firms. The pattern of consumer preferences is the way consumer demand is distributed across different goods and services. The structure of production can be matched to the pattern of consumer preferences by firms responding to price signals and changes in demand. How markets interact with one another is shown by changes in one market affecting supply and demand in related markets. This affects productive and allocative efficiency as resources shift towards their most efficient and valued uses. Firms do not always behave in a way that benefits all economic agents, and governments may intervene to regulate the power these firms have. Market failure is a situation where the free market does not allocate resources efficiently, leading to a loss of economic welfare. Market power is the ability of a firm or group of firms to influence prices, output, or market conditions. A cartel is a group of firms that formally agree to coordinate prices, output, or market behavior to reduce competition. Cartels have some significance over market power as they enable firms to act collectively like a monopoly and raise prices above competitive levels. However, cartels may have little significance over market power as they are unstable and may collapse due to cheating or regulatory intervention. This may have an impact on market failure as reduced competition can lead to higher prices, lower output, and allocative inefficiency. Collusion is cooperation between firms, either formally or informally, to reduce competition and increase joint profits. Collusion has some significance over market power as it allows firms to coordinate behavior and exert greater control over prices. However, collusion may have little significance over market power as it is difficult to sustain where firms have incentives to undercut rivals. This may have an impact on market failure as coordinated behavior can distort price signals and misallocate resources. Restrictive practices are actions by firms that limit competition, such as price fixing, output restrictions, or exclusive agreements. Restrictive practices have some significance over market power as they strengthen firms' ability to control the market and deter entry. However, restrictive practices may have little significance over market power as competition law can limit or eliminate their effectiveness. This may have an impact on market failure as reduced competition can lead to inefficiency and consumer welfare loss. Tacit agreements are unwritten and unspoken understandings between firms to avoid competition without explicit communication. Tacit agreements have some significance over market power as they allow firms to maintain high prices without forming illegal contracts. However, tacit agreements may have little significance over market power as changing market conditions can break coordinated behavior. This may have an impact on market failure as sustained high prices can reduce consumer surplus and efficiency. Monopsony power is the ability of a single buyer to influence prices paid to suppliers or workers. Monopsony power has some significance over market power as it allows buyers to push prices or wages below competitive levels. However, monopsony power may have little significance over market power as supplier mobility and regulation can reduce buyer dominance. This may have an impact on market failure as underpayment can lead to inefficient allocation of resources. Natural monopolies are markets where high fixed costs mean one firm can supply the entire market at a lower average cost. Natural monopolies have some significance over market power as the dominant firm can exploit consumers through higher prices. However, natural monopolies may have little significance over market power as regulation can control prices and output. This may have an impact on market failure as regulation can reduce inefficiency while allowing economies of scale. Power in the labor market is the ability of employers or workers to influence wages and employment conditions. Power in the labor market has some significance over market power as dominant employers can suppress wages and working conditions. However, power in the labor market may have little significance over market power as trade unions and labor laws can counterbalance employer influence. This may have an impact on market failure as distorted wages can lead to inefficiency and inequality. The implications of market failure in the business world for economic agents are higher prices, reduced choice, inefficiency, and lower welfare. The implications of market failure in the business world for governments are the need for regulation, competition policy, and intervention to improve efficiency and equity. Business regulation is the use of rules and laws by governments or authorities to control business behavior and promote fair markets. Businesses can be regulated to promote competition, regulate natural monopolies, protect consumers, and protect employees. Business can be regulated by the Competition and Markets Authority and EU competition policy. Competition would be promoted because it encourages efficiency, innovation, lower prices, and greater choice for consumers. Competition could be promoted by preventing anti-competitive practices as firms are stopped from colluding or abusing dominant positions. This would help competition as markets remain open and fair for new and existing firms. Competition could be promoted by controlling mergers and takeovers as authorities can block or restrict deals that reduce competition. This would help competition as it prevents the creation of monopolies or overly dominant firms. Competition could be promoted through privatization as state-owned firms are exposed to market forces. This would help competition as private ownership can encourage efficiency and innovation. Businesses can be regulated to regulate natural monopolies as price caps and quality standards can be imposed. This would be done so consumers are protected from excessive prices and poor service. Businesses can be regulated to protect consumers as safety standards, product information rules, and consumer rights laws are enforced. This would be done so consumers are not exploited or misled. Businesses can be regulated to protect employees as laws on minimum wages, working hours, and health and safety are enforced. This would be done so workers are treated fairly and protected from exploitation. The Competition and Markets Authority has the role of promoting competition and preventing anti-competitive behavior. Businesses can be regulated by the Competition and Markets Authority as it investigates mergers, cartels, and abuse of dominance. This would be done so markets operate efficiently and in the public interest. Businesses can be regulated by EU competition policy as firms must comply with rules on state aid, cartels, and market dominance. The impact of EU competition policy is increased competition, consumer protection, and fair trading across member states. The benefits of regulation are increased competition, greater consumer protection, improved product quality, and reduced abuse of market power. However, the costs of regulation are higher compliance costs for firms, reduced incentives for innovation, increased bureaucracy, and the risk of regulatory capture. Markets may not produce outcomes that are always considered socially desirable. This may prompt governments to intervene in an attempt to change the outcomes. Market failure is a situation where the free market fails to allocate resources efficiently, leading to a loss of economic and social welfare. Market failure in society is the result of inefficient resource allocation causing outcomes that do not maximize overall welfare or benefit society as a whole. The consequences of the underprovision of merit goods and services are poorer education, weaker healthcare outcomes, and reduced long-term productivity. The consequences of the underprovision of other goods and services are shortages, reduced consumer choice, and unmet social or economic needs. This leads to market failure in society as resources are not allocated to goods and services that generate the greatest overall benefit. The consequences of the underconsumption of merit goods and services are lower human capital, increased inequality, and higher future social costs. The consequences of the underconsumption of other goods and services are reduced economic efficiency and lower overall welfare. This leads to market failure in society as individuals fail to consume goods that provide significant benefits beyond themselves. Positive externalities are benefits to third parties arising from the consumption or production of a good or service. This leads to market failure in society as goods with positive externalities are underconsumed or underproduced by the market. Negative externalities are costs imposed on third parties as a result of the consumption or production of a good or service. This leads to market failure in society as goods with negative externalities are overconsumed or overproduced. A demerit good is a good or service that is overconsumed due to consumers underestimating its long-term costs. The consequences of the overconsumption of demerit goods and services are increased healthcare costs, reduced productivity, and wider social harm. This leads to market failure in society as consumption decisions impose costs on others that are not reflected in market prices. Occupational immobility is the inability of workers to change jobs due to a lack of skills, qualifications, or training. This leads to market failure in society as labor resources are not used efficiently across the economy. Geographical immobility is the inability of workers to move between locations to access employment opportunities. This leads to market failure in society as labor shortages and unemployment persist in different regions. Imperfect information is a situation where consumers or producers do not have full knowledge about a good or service. This leads to market failure in society as decisions are made that do not maximize welfare. Asymmetric information is where one party in a transaction has more information than the other. This leads to market failure in society as unequal access to information distorts market outcomes. Environmental change is the alteration of natural conditions due to economic activity or human behavior. Environmental change can impact the economy as it increases costs, reduces productivity, and damages long-term growth prospects. This leads to market failure in society as environmental costs are not fully accounted for in market decisions. Externalities are the positive or negative effects of economic activity on third parties that are not reflected in market prices. Private benefits are the direct gains received by individuals from the consumption or production of a good or service. External benefits are the positive spillover effects enjoyed by third parties who are not directly involved in the transaction. Social benefits are the total benefits to society, combining both private benefits and external benefits. These can lead to market failure across the economy as goods with significant external benefits tend to be underconsumed or underproduced. Private costs are the costs faced directly by producers or consumers when making an economic decision. External costs are the negative spillover effects imposed on third parties who are not part of the transaction. Social costs are the total costs to society, combining both private costs and external costs. These can lead to market failure across the economy as goods with external costs tend to be overconsumed or overproduced. The impact on society of charging prices that do not reflect total internal costs are inefficient production decisions and misallocation of resources. The impact on society of charging prices that do not reflect total external costs are overconsumption, environmental damage, and reduced social welfare. The impact on society of charging prices that do not reflect total internal and external costs are widespread inefficiency and long-term welfare losses. Environmental externalities are the positive or negative spillover effects of economic activity on the natural environment. These can affect the economy as they increase costs, reduce productivity, and damage long-term growth. These can lead to market failure across the economy as environmental impacts are not fully reflected in market prices. The different policies that are used to deal with market failure are the provision of public and merit goods, indirect taxation of demerit goods, tradable pollution permits, provision of information, legislation, and regulation. The provision of public goods are the supply of goods that are non-rival and non-excludable, such as defense and street lighting, funded by the government. This deals with market failure as public goods would otherwise be underprovided or not provided at all by the free market. The short-term impact of the provision of public goods on the economy is increased government spending and higher aggregate demand. The long-term impact of the provision of public goods on the economy is improved productivity and sustained economic growth. The short-term impact of the provision of public goods on society is improved access to essential services. The long-term impact of the provision of public goods on society is greater equality and improved quality of life. The provision of merit goods are government-funded or subsidized goods and services such as education and healthcare. This deals with market failure as it increases consumption of goods that generate positive external benefits. The short-term impact of the provision of merit goods on the economy is increased public spending and higher employment. The long-term impact of the provision of merit goods on the economy is a more skilled and productive workforce. The short-term impact of the provision of merit goods on society is increased access to healthcare and education. The long-term impact of the provision of merit goods on society is improved health outcomes and social mobility. The indirect taxation of demerit goods is the use of taxes on goods such as tobacco and alcohol to raise their prices. This deals with market failure as higher prices reduce overconsumption and internalize external costs. The short-term impact of the indirect taxation of demerit goods on the economy is higher prices and reduced consumption. The long-term impact of the indirect taxation of demerit goods on the economy is lower external costs and reduced strain on public services. The short-term impact of the indirect taxation of demerit goods on society is reduced consumption of harmful goods. The long-term impact of the indirect taxation of demerit goods on society is improved public health and lower social costs. Tradable pollution permits are government-issued allowances that limit the amount of pollution firms are allowed to produce. These deals with market failure as they reduce negative externalities by capping pollution and creating financial incentives to cut emissions. The short-term impact of the indirect taxation of demerit goods on the economy is higher prices and reduced consumption. The long-term impact of the indirect taxation of demerit goods on the economy is lower external costs and reduced strain on public services. The short-term impact of the indirect taxation of demerit goods on society is reduced consumption of harmful goods. The long-term impact of the indirect taxation of demerit goods on society is improved public health and lower social costs. The provision of information is the supply of clear and accurate information to consumers about the costs and benefits of goods and services. This deals with market failure as it reduces imperfect and asymmetric information. The short-term impact of the provision of information on the economy is improved decision-making by consumers and producers, leading to more efficient allocation of resources. The long-term impact of the provision of information on the economy is increased productivity and sustained economic efficiency as markets function more effectively. The short-term impact of the provision of information on society is greater awareness of the costs and benefits of different goods and services. The long-term impact of the provision of information on society is improved welfare and healthier, more informed consumer behavior. Legislation and regulation is the use of laws and rules to control production and consumption decisions. These deal with market failure as they directly restrict harmful activities and enforce standards. The short-term impact of legislation and regulation on the economy is increased compliance costs for firms. The long-term impact of legislation and regulation on the economy is more sustainable and stable economic activity. The short-term impact of legislation and regulation on society is improved protection for consumers and workers. The long-term impact of the legislation and regulation on society is greater safety, fairness, and overall welfare. Economic fluctuations may well affect the fortunes of firms and individuals, and this encourages a demand for policies that reduce harm and promote well-being. The ADCS model is a macroeconomic framework used to show how the overall price level and real output in an economy are determined by the interaction of aggregate demand and aggregate supply. The ADCS model sheds light on the economy as a whole as it shows how policies, shocks, and structural changes affect growth, inflation, and employment. Aggregate demand is the total level of spending on goods and services in an economy at different price levels over a given period of time. Macroeconomic policies create changes in aggregate demand as fiscal and monetary measures influence consumption, investment, government spending, and net exports. The impact of these changes on inflation is that an increase in aggregate demand tends to cause demand pull inflation where spending grows faster than productive capacity. The impact of these changes on unemployment is that higher aggregate demand usually reduces unemployment by increasing output and labor demand. Aggregate supply is the total amount of goods and services that firms are willing and able to produce at different price levels. Macroeconomic policies create changes in aggregate supply as supply-side policies improve productivity, reduce costs, and increase the efficiency of markets. The impact of these changes on inflation is that an increase in aggregate supply can lower inflationary pressure by allowing more output at the same price level. The impact of these changes on unemployment is that greater aggregate supply can reduce unemployment by supporting sustainable economic growth. Full capacity output is the level of output where all available resources are fully employed without causing accelerating inflation. Macroeconomic policies lead to full capacity output as demand-side and supply-side measures are balanced to close output gaps. The multiplier effect is the process where an initial increase in spending leads to a larger final increase in national income. Macroeconomic policies can lead to the multiplier effect as government spending or tax cuts stimulate further rounds of consumption. Demand-side policies are government and central bank actions designed to influence the level of aggregate demand in the economy. There are two types of demand-side policies, fiscal and monetary policies. Fiscal policies are decisions by the government on spending and taxation, including direct taxes on income and indirect taxes on goods and services. Monetary policies are actions taken by the Bank of England through its Monetary Policy Committee to influence the supply and cost of money and credit in the economy. A type of monetary policy is interest rates, which are the cost of borrowing money and the reward for saving, set by the Bank of England. Another type of monetary policy is quantitative easing, which is the creation of new money by the Bank of England to buy financial assets and increase spending in the economy. Demand-side policies can be shown on an ADCS diagram by a shift of the aggregate demand curve to the right or left. The level of aggregate demand would be changed by increases or decreases in government spending, taxation, interest rates, and the availability of credit. The impact of the changing level of aggregate demand on the economy is that higher demand can increase output and employment, while lower demand can reduce growth and raise unemployment. Demand-side policies can encourage investment, job creation, and economic growth. Demand-side policies can encourage investment by lowering interest rates and increasing confidence through higher government spending. Demand-side policies can encourage job creation by stimulating demand for goods and services, leading firms to hire more workers. Demand-side policies can encourage economic growth by increasing overall spending and boosting short-run output. Demand-side policies are also able to control inflation and unemployment. Demand-side policies can control inflation by reducing aggregate demand through higher taxes or higher interest rates. Demand-side policies can control unemployment by increasing aggregate demand and reducing cyclical unemployment. There would be a time lag after the implementation of a demand-side policy, as it takes time for policy decisions to be passed, implemented, and felt throughout the economy. The strengths of demand-side policies are that they can be implemented relatively quickly and are effective at managing short-term economic fluctuations. However, the weaknesses of demand-side policies are that they may cause inflation, increase government debt, and be ineffective if consumer and business confidence is low. Policymakers may face a conflict between controlling inflation and reducing unemployment, as policies that boost demand can lower unemployment but raise inflation. There is also a trade-off between short-term economic growth and long-term stability, where expansionary policies may increase debt and inflationary pressure. Additionally, using fiscal and monetary policies together can create conflicts where one policy offsets the effects of the other, reducing overall effectiveness. Supply-side policies are measures designed to increase the productive potential of the economy by improving efficiency, productivity, and the operation of markets. Supply-side policies can be shown on an AD-phase diagram by a rightward shift of the long-run aggregate supply curve. There are two types of supply-side policies: market-based and interventionist. Market-based policies are approaches that rely on market forces by reducing government intervention, lowering taxes, and deregulating industries. Whereas interventionist policies are approaches where the government directly intervenes through spending, regulation, and planning to improve long-term productive capacity. Market-based policies increase incentives by lowering income and corporation taxes, allowing individuals and firms to keep more of their earnings. Market-based policies promote competition by deregulating markets and privatizing industries, reducing barriers to entry for new firms. Market-based policies reform the labor market by increasing flexibility through reduced trade union power and more flexible employment contracts. Market-based policies improve the skills and quality of the labor force by encouraging private investment in training and education. Market-based policies improve the infrastructure by encouraging private sector involvement and investment in transport, energy, and communications. Interventionist policies increase incentives by using targeted subsidies and tax credits to encourage employment, training, and investment. Interventionist policies promote competition by enforcing competition laws and regulating monopolies to prevent abuse of market power. Interventionist policies reform the labor market by introducing minimum wages, employment protection, and active labor market programs. Interventionist policies improve the skills and quality of the labor force by increasing government spending on education, apprenticeships, and vocational training. Interventionist policies improve the infrastructure by using public investment to fund large-scale projects such as roads, railways, and digital networks. The strengths of supply-side policies are that they can increase long-term economic growth, reduce inflationary pressure, and lower structural unemployment. However, the weaknesses of supply-side policies are that they often take a long time to have an effect and can be expensive or politically unpopular. Policymakers may face a trade-off between short-term economic stability and long-term growth, as supply-side policies often take time to show results. There can also be conflicts between efficiency and equality, where market-based reforms improve productivity but increase income inequality. Additionally, higher government spending on interventionist policies may conflict with objectives to control public debt and taxation levels. The possible impact of demand-side macroeconomic policies are increased aggregate demand, higher economic growth, lower unemployment, and potentially higher inflation. The possible impact of supply-side macroeconomic policies are increased productive capacity, improved efficiency, lower structural unemployment, and reduced inflationary pressure. Using fiscal policy as a demand-side policy can be more effective than monetary policy, as it directly targets spending and taxation, allowing the government to influence aggregate demand more precisely. However, using monetary policy can be more effective as it can be implemented quickly by the central bank and avoids increasing government debt. Using market-based policy as a supply-side policy can be more effective than interventionist policy, as it relies on incentives and competition to improve efficiency with less government intervention. However, using interventionist policy can be more effective as the government can directly invest in education, training, and infrastructure where market failure exists. Using demand-side policy can be more effective as a macroeconomic policy than supply-side policy, as it can quickly stabilize the economy during recessions. However, using supply-side policy can be more effective as it addresses long-term economic growth and reduces inflationary constraints. The criteria for success of macroeconomic policy is achieving sustained economic growth, low and stable inflation, and low unemployment. Macroeconomic policy is effective when it meets its objectives without creating significant negative side effects. However, it is ineffective when time lags, policy conflicts, or external shocks prevent it from achieving its intended outcomes. Firms and individuals require access to credit to meet their respective needs. The financial sector provides a system that facilitates growth and development. Economic policies regulate that system in the hope of ensuring stability. Risk is the likelihood of an outcome occurring where the probability and potential impact can be measured and managed. Whereas uncertainty is the condition where outcomes or probabilities cannot be accurately predicted or quantified. The impact of shocks on the financial sector are increased volatility, reduced confidence, and potential instability across markets and institutions. Exchange rates are the value of one currency measured against another, determined by supply and demand in foreign exchange markets. The risks that exchange rates impose on the financial sector are losses from currency fluctuations that affect international trade, investment returns, and balance sheets. Forward markets are financial markets where contracts are agreed to exchange currencies or assets at a fixed future date and price. The impact of forward markets on the financial sector are greater stability and predictability as firms can hedge against adverse price movements. The role of insurance in business is to reduce financial exposure by transferring risk to insurers, allowing firms to operate with greater certainty. The role of the financial sector is to mobilize savings for lending to firms and individuals, lend to businesses for investment in working capital, lend to individuals, facilitate the exchange of goods and services, assess creditor risk, provide forward markets in currencies and commodities, and provide a market for equities. The role of the financial sector to mobilize savings for lending to firms and individuals is to collect deposits from savers and channel them to borrowers through banks and other financial institutions. The role of the financial sector to lend to businesses for investment in working capital is to provide short-term and long-term finance that allows firms to manage cash flow, purchase inputs, and expand production. The role of the financial sector to lend to individuals is to offer credit such as loans and mortgages that enable households to finance consumption and major purchases over time. The role of the financial sector to facilitate the exchange of goods and services is to provide payment systems and financial infrastructure that allow transactions to take place efficiently and securely. The role of the financial sector to assess creditor risk is to evaluate the likelihood of borrowers repaying loans by using information, credit checks, and risk assessment techniques. The role of the financial sector to provide forward markets in currencies and commodities is to allow firms to hedge against future price changes by fixing prices in advance. The role of the financial sector to provide a market for equities is to enable companies to raise capital by selling shares and allow investors to buy and sell ownership stakes. The central bank is the national institution responsible for managing a country's monetary system, maintaining financial stability, and overseeing the banking system. The role of the central bank is the setting of the official interest rate through the Monetary Policy Committee, the implementation of monetary policy to control inflation, the regulation of the banking industry through the Bank of England's Financial Policy Committee, and acting as banker to the banks as lender of last resort. The role of the Monetary Policy Committee in setting the official interest base rate is to influence borrowing and spending by adjusting rates through regular meetings based on economic data and forecasts. The implementation of monetary policy to control inflation is achieved by the central bank using tools such as interest rate changes and asset purchases to keep inflation close to its target. Regulation of the banking industry by the Bank of England's Financial Policy Committee is to reduce systemic risk by monitoring financial stability and imposing rules such as capital requirements on banks. Banker to the banks as lender of last resort is the role where the central bank provides emergency liquidity to financial institutions facing short-term funding problems to prevent wider financial collapse. The global financial crisis was a severe worldwide economic downturn triggered by instability in the financial system and the collapse of major financial institutions in 2007 to 2009. The contributing factors were subprime mortgages, moral hazard linked to institutions seen as too big to fail, the collapse of lending to businesses, speculation and market bubbles, and the role of organizational culture. Subprime mortgages contributed to the global financial crisis by extending high-risk loans to borrowers unable to repay, leading to widespread defaults and falling asset values. Moral hazard linked to institutions seen as too big to fail contributed to the global financial crisis by encouraging excessive risk-taking as banks expected government bailouts if they failed. The collapse of lending to businesses contributed to the global financial crisis by restricting investment, reducing production, and increasing unemployment across economies. Speculation and market bubbles contributed to the global financial crisis by inflating asset prices beyond their true value, followed by sharp corrections that destabilized financial markets. The role of organizational culture contributed to the global financial crisis by promoting short-term profit-seeking and excessive risk-taking within financial institutions. The role of banking regulation during the global financial crisis was weak and insufficient, allowing risky practices to develop without effective oversight. The impact of the financial sector on economic agents during the global financial crisis was rising unemployment, falling incomes, reduced access to credit, and increased economic insecurity. The impact of the financial sector on governments during the global financial crisis was higher public debt and budget deficits due to bank bailouts and economic stimulus measures. Thank you for watching this video on making markets work. I'll see you in the next one.